Welcome to the Alpha Mind podcast, where we are delighted to welcome back a friend of the show, Jonathan Baird, an award-winning money manager and publisher of the Global Investment Letter. Jonathan speaks and writes about macro themes in markets based on his many decades of experience in this area. In this episode, we talk about how to be more aware of the macro fundamental factors in markets and how to successfully fuse macro fundamental analysis, market valuation approaches, technical analysis, and market sentiment into a coherent risk approach. First, we would like to thank our podcast sponsorship partners, without whose support this show would not be possible. TradeStation Global and the Society of Technical Analysts, the STA. TradeStation Global is a multi-asset trading platform with access to international markets. Trade stocks, forex, futures, and micro e-mini futures from one account. Leverage professional-grade tools like Radar Screen, The Matrix, and Easy Language, an intuitive coding language for traders. And with TradeStation Global, there are no hidden price spreads, just transparent, low commissions. To find out more and open an account, visit tradestationinternational.com/alphamind or see the link in the episode description. TradeStation International Limited is authorised and regulated by the Financial Conduct Authority in the UK and acts as an introducing broker to Interactive Brokers UK Limited. The firm does not provide investment advice or trading recommendations. Investment and trading involves risk, including possible loss of principal. At present, the TradeStation Global product is not available to EU residents. The Society of Technical Analysts, the STA, are another long-established organisation with a great reputation. They are a member-led and not-for-profit body who have been providing world-beating education to the trading and investment community for over 5 decades and serve the needs of their members by providing outstanding online talks and webinars, regular newsletters, education, diplomas, and continued professional development programs. Their home study course has been created by many of the world's leading minds in technical analysis and provides learning of a depth and breadth that is unparalleled in the trading and investing world. Listeners to the Alpha Mind podcast can obtain a 10% discount on the cost of the STA home study course. Visit alpha-mind.net and go to the sponsor section of our page to find out how to obtain this. Now, on with this week's podcast.
We're delighted to have Jonathan Baird back with us. Now, some of you may remember one of the key quotes of Jonathan from all that time ago was, "I have seen the enemy and he is us," from one of our podcast number 73, if you want to go back and listen to that. But the reason why we got Jonathan back with us is that, Jonathan is the editor and creator of the Global Investment Letter, which is a phenomenally well-read piece of work about macro. And since we last spoke with Jonathan, the world has gone bonkers around macro themes. And we thought it really important to get Jonathan back just to sort of, perhaps go over the last 18 months or whatever it is. Jonathan, guess, what suddenly changed in the world? And what impact are you seeing it happening? And how do you see all this going forward? What could this lead to? But also understanding that a lot of our audience may not have been paying attention to macro at all in the way that they've been trading. They may have just been trading the flows and new to the market and treating it like a game and getting carried out, because of things suddenly changing direction without them being totally prepared for that, and not really understanding really what macro is. And I think perhaps a good starting point is just to get you to, with your experience of this topic, just to start off with the sort of broad brush. What does macro mean? What does it mean to you? What have you seen, and how have you seen, macro strategy evolve and rapidly evolve, even over the last year or so? Anyway, Jonathan, welcome to the show. Let's start there.
Thanks very much, Mark and Stephen. I think your point about paying attention to macro and its importance is very important, because when I started my career as a money manager in the 80s, I was a pure value investor and gave really very little attention to the macro considerations. And fortunately, I started my career in an era where the macro environment was about as benign as one could get. But then, as I progressed in my career, my investment approach changed and got, I suppose, in one sense, more pragmatic. In that, as I started managing more money, and as time went on, and we saw the fall of the Soviet Union and so on, macro considerations tended to play a larger role in my thinking, and that role, whether it's central bank policy or geopolitics, or over the last few years the appearance of a pandemic and so on, all have become sort of essential drivers of my investment approach that produces a strategy for investing in stocks, bonds, currencies, and so on. And I'd make the observation to anybody now that the environment that we're living in currently makes it incumbent on anybody who's a serious investor to start paying attention to macro considerations, because I think the macro considerations are going to have a profound effect on investment results. Well, not only currently, but I suspect that we're going to see the 2020s as being defined or characterized as an era of very high market volatility because of those macro considerations. But on a positive note, while that volatility is likely to present a lot of fairly significant risk for investors, I think if you're an active investor, as I have always been, I think that volatility could produce some great opportunities. So for me, looking at factors such as central banks policy, geopolitics, whether we've had obviously the ongoing war in Ukraine and so on. We're seeing issues in China and so on. Even the European Union and Brexit are all geopolitical factors that I think have and will play a role in investment results going forward.
Yeah, great. I think it's interesting, isn't it, Al? Predicting macro would have been a bit difficult 2 years ago. I think you got everything wrong, right? It's the sort of things that have turned up, the unpredictability of it, and just the impact of it is just phenomenal.
It has been. One of the things that I rely on, and it's a saying that I repeat because I think it's important, is that as investors, we don't have the luxury of dealing in certainties, but we have to deal in probabilities. And so when I'm calculating sort of the potential effects of these various macro factors, I tend to attach probabilities to their outcomes, and that helps me, at least gives me a direction to form my investment strategies. The other thing too, as investors, more so now than perhaps at any time, is that we also have to be responsive to change and be quick to recognize mistakes or the development of events, and be prepared to adjust our investment positions and not be dogmatic. And all of those principles that I've incorporated over the years, through hard-won experience, through some successes and some challenges over the years, they've all certainly worked very well over the last few years in mitigating risk and taking advantage of the opportunities that have appeared. And I'm cautiously optimistic about the years ahead, because I have too much experience to get more than cautiously optimistic about anything these days. So, but I do think that the volatility that I expect, for the balance of the decade is going to produce also some pretty attractive investment opportunities. I would say that I'd much rather be an active investor going forward in the years to come than a passive investor. But that's a whole other issue that I could go on a complete tangent about. So,
hi, Jonathan.
Yeah.
Great to have you from my personal perspective. Great to have you back, a friend of the podcast,
Yes,
um,
absolutely.
back on the show. And we had some great feedback when you were on first time. And it's, we often um, focus on the behavioral, the psychological, the emotional aspects of trading and investing. But it's great sometimes to sort of look at some of these other vital aspects, of how you find value, how you determine value, some of the process aspects that go into your trading. I'm always fascinated with macro, and I recall something you said last time you were on the show, which stood out for me, which was that I think you were already quite cautious about the macroeconomic outlook. I think we recorded it in about May or June of 2021.
Right.
Um, but you were staying long of equities because I think if I remember rightly, you said the sentiment was still for higher equity prices. Um, that kind of highlights one of the challenges with macro. To sort of sometimes it moves slowly, or the market takes a long time to come round to it, or timing it can be particularly challenging. How do you cope with that, and how do you factor that into how you work?
Yeah, no, Stephen, your recollection is absolutely right, and I was concerned as early as early 2021 about markets, but I did not actually exit markets, my various long positions, until very early this year in 2022, when they hit my sell prices. I'm a big advocate of attempting to mitigate risk by using things like stop losses and so on, which I adjust as the market movement dictates, and I incorporate not only just my experience as a money manager over the years, but also some technical levels that I think are important and so on. And so while I was concerned, and I obviously in retrospect I was right to be concerned, I did not actually get into the market until early 2022 because despite whatever I might have been thinking, market price action was not confirming my beliefs. And so I remember writing in the Global Investment Letter that rarely has a man been more bearish and more long than I was in 2021. And fortunately, that discipline did work out very well because I held on and I got out. I think the bulk of my sales was in January and early February, so that allowed me to keep the bulk of the profits that I'd earned over the course of the previous bull market. But I was writing. I think I put out a weekly market comment that people can subscribe to for free. It's just an unsubscribe to whenever they want. They just have to leave their name and email address and so on. And I think it was last week I put up a chart that looked at the price action of the FANGs stocks and other market leaders versus the S&P 500. And one of the historic indications of a bull market nearing an end is when the leaders of the bull market start to weaken in terms of relative performance. And we started seeing evidence of that in the last half of 2021. And that tends to, because of their large weightings, the large market leaders tend to exert first a slowing influence on markets, and then the markets will eventually roll over. And we've seen that with the FANG stocks and Teslas and so on. And then they become the leaders of the bear market. And if you look at some of the price charts of Tesla and Facebook or Meta now, there's evidence that, they've come off quite a bit. So all of these things in terms of historic precedent and macro considerations and geopolitics, I used to follow the Chinese equity markets quite closely and invested in them in the past. But then I was always investing in China with the caveat that could change, if adverse geopolitical influences arose. And I started to get a bit concerned about developments in China, for example, particularly sort of around Hong Kong and so on. And it caused me just purely on a risk reward basis, it caused me to sort of just withdraw from that market, which I think probably in retrospect is proven to be, a prudent thing. So I'm always looking for ways to optimize risk and reward, and hopefully, recognize mistakes early. And so the environment that we're in now and going forward is, as I've said before, is likely to produce a lot of volatility, which means that I'm going to have to be very mindful myself of staying as pragmatic in my not only my market analysis, but also in my trading activity.
So it's amazing the way you talk about that, and it's a great lesson for younger traders, because you must have been holding a cognitive dissonance within your head. The way you described that you were probably the most bearish long on the street, if that was
Yes.
quite the phrase you used. It wasn't quite the phrase, but
Well, that's essentially it, though, Stephen. You're absolutely right.
yeah,
I was fully aware. I was fully aware of the various risks and catalysts for volatility that were available. But I also have learned from the past, and also from mistakes I made in the past in not recognizing that you need to rely on price action to vindicate your market analysis. I mean, I've the opportunity cost that I incurred in the past when I was younger by not waiting for price action to vindicate my concerns, is probably pretty considerable. I mean, a classic example of that was the internet bubble. I was very, very concerned about sort of the state of markets. And while I made some money on the way up, I ended up growing more and more concerned about where this was likely to end. And I was convinced, I mean, I knew what was going to happen, but the timing always with markets is always uncertain. So in retrospect, I probably should have, I would have captured more of the upside then had I waited for price action to confirm my own analysis, because timing is obviously, a variable in every sense of the word. So from that time, I've learned since then that whatever my view of the markets are, whether it's bearish or bullish, I'll wait for price action to confirm that, because that's going to reflect investment sentiment. And investment sentiment is obviously the biggest driver of markets ultimately over time. That because without investments, without extremes of bearishness and bullishness, you'd never get market bubbles or crashes like we saw in 1929 or 87. So you got to be a bit mindful of changes. And I attempt to sort of be an early get an early sense of changes in market sentiment, and there's a set of tools that I use for that as well. But price action in all markets, not just stocks, currencies, commodities, or whatever, ultimately contains a lot of valuable information. And so there was that cognitive dissonance, which I think experience allowed me to manage without sort of it taking too much of an emotional toll on me, which it could have if I was younger, you know.
And do you think the fact that you're a macro thinker sort of protects you to some extent from the emotions that flow through market, and just being of a slightly different perspective in terms of, you know, how you hold a trade and how you manage a trade? Do you feel protected in the way that, you know, by having a macro view, or exposed?
I think that it's helpful in that it provides me with a bit more context in terms of placing and managing the trade over time, and that I think is helpful emotionally. I think I wrote a piece. I wrote a piece in one of my little weekly things not long ago, and I used the phrase that clarity equals confidence, and I was making the point that the more work you do on a trade and the more context you have, it allows you to have more confidence in the decisions you've made, and the confidence can be somewhat protective on an emotional basis. At the same time, you know, I had to mention immediately the caveat that you have to be on guard for overconfidence and always be, questioning your own state of mind and so on. One of my little sayings is that, you know, perhaps the most important question that a trader or an investor can ask themselves is, what is it going to take for me to change my mind on this trade or investment? And if you do that, if you when you buy something or sell something, if you put in a set of criteria that will cause you to sort of reconsider your thinking, I've found that to be a very valuable way of avoiding making poor trades worse and not staying with winning trades. So I hope that sort of addressed some of your.
Yeah, no, indeed. I think it's a useful point about, you know, trade entry and having a bigger picture awareness. I think one of the mistakes that I've seen many short-term traders sort of adopt as a habit actually is to not look at the very long-term charts, you know, not have a perspective as to where we've come from, and, you know, the preceding trend. And I think I was talking with some neighbors, they're all sort of, you know, market professionals. And I said to them, you know, do you remember where did the Dow get to after the banking crash in 2008? And the range, they said, was somewhere between 15,000 to 20,000 was their response. Yeah. I said, no, it got down to 8,000.
That's right. Yeah.
Right. And we're at 32 and a half now.
Yeah.
It got down to 8,000. And people sort of forget that, you know, and so knowing where we've come from and, you know, taking data back and trend lines back to real sort of ancient points of contact and understand where those lines come in within the context of a short-term trader's charts, you know, to be blind to that is just ridiculous. But there are a lot of people that operate blind, trading short-term without a sense, particularly around technicals, of what the macro from a technical perspective looks like. You know, and it's something that they need to wake up to, really, that macro thinking economically and the geopolitical is one thing, but also macro thinking in terms of how you're reading charts is also.
I think you're absolutely right, Mark, and I think that in this environment, because there are so many potential catalysts for volatility on the macro side in terms of central bank actions and geopolitics and so on, that can certainly affect short-term traders, perhaps even more than longer-term traders, because if an adverse event comes to light overnight or so on, it can, it can quickly scuttle some, very well thought out positions. And so, ignoring those kind of facts are dangerous, regardless of the time frame that you're trading or investing in these days. You've got the Russian invasion of the Ukraine, may well end up having a significant impact on energy prices before the end of the winter. You look at central bank policy, which I don't think markets are fully appreciating how much momentum there is for central banks to continue to increase interest rates. I hear and see a lot of conversation about the much hoped for central bank pivot happening very soon. And I started hearing that back in July, August. And I think there's some good reasons why central bank rate increases may be more persistent than the market is anticipating. I think the Liz Truss's short, unlamented tenure as prime minister was interesting for a couple of reasons, but specifically the market's reaction to her economic plan and the tax cuts, which were going to balloon the British budget deficit and so on, and the reaction of markets. That was interesting to me because I think more than just sort of the policy itself, it indicated what kind of stresses are at work in the global financial system. Because a few years ago, the Trump administration in the United States did exactly the same thing, where they cut taxes for the higher tax rate individuals, and it ballooned. It served to balloon the U.S. budget deficit, but the markets did not react to that. But the fact that it reacted to essentially the same policy in the UK a little later on, to my mind, suggests that there is a growing amount of structural stressors going on in the global financial system, which as a trader investor makes me obviously wary and trying to be alert for developing trends. You look at what's happening with Credit Suisse and their what's going on in their collateral debt obligations and so on. The prices are just they're back to rising significantly again. So all of these things to me are at least suggestive that the number of catalysts for market volatility is increasing rather than abating. And so I think as investors, we have to, proceed accordingly.
Yeah, no, that's terrific. And just a reminder, of course, to anyone listening that all opinions expressed here are just that, they're opinions. They're not recommendations.
No, not at all. Not at all.
Yeah.
And you're absolutely right. And Stephen, if new information comes to light, I could change my mind after we get off the call.
Absolutely. But you have made some fascinating points, because the incident with Liz Truss reminded me of some of the instances that I'd experienced in my trading career when market liquidity just evaporated. We had it obviously in a form around the pandemic, but that was from an external event. I guess what you're talking here is about government policies, bond issuance, abilities to fund budget deficits, central bank decisions on rates. They're all back in play.
Yes.
And that adds, something which hasn't really been part of the agenda for a long time. Central bank action perhaps in the past few years has been directed towards saving stock markets at various times. And I think a lot of people, this is part of the challenge. I think, unless you were around in the 80s or 90s, such as, aging gobs on sticks like myself and Mark, um, you know,
Excuse me?
yeah, a lot of people haven't seen this before. They've not seen macro at work in this way, and it's fascinating to see it and to see what happened with that temporary breakdown in the gilt markets.
Yeah, and it's the kind of thing that unfortunately, I think it may be the kind of thing that we're going to see again before the end of the decade. Central banks come under a lot of criticism, but I just must say that they have a very difficult job on their hands. One of the challenges of being a central banker is the fact that their actions tend to have a fairly significant lag effect. So it's very difficult for them to know exactly how much influence they should exert on interest rates and money supply and so on to get the desired result. And I will say that I think central banks did the right thing in bailing out the financial system in 2008. And I think also some actions needed to be done with the shock that came from the appearance of COVID. So while I think that they're both needed to be done, at the same time, the developed world has found itself now through circumstances in a situation where they've got an enormous amount of debt and are attempting to reset the interest rate policy back to more historic norms. Because the interest rates that we've had for the last number of years have, while they've been welcome, I guess, if you're a borrower of money, the fact that they're so low and negative in Europe and in Japan, or at least they were negative in Europe and still are in Japan, they're exerting a profound distorting effect on the global economy. And one of the reasons why I think that central banks are being as aggressive in raising rates as they are is that they see the current surge in inflation as an opportunity for them to try and reset rates to closer to the longer term historic norms. And one of the reasons is just to restore rates to a level that exerts a certain amount of financial discipline on the system, but also too, by raising rates, it also provides them with a tool to combat the subsequent recession. But with negative interest rates, or essentially interest rates at zero, and ballooning monetary policies and so on, going into this cycle of tightening, the central banks basically had next to no tools left to combat another financial shock. And I think that the leverage that's inherent in the global system suggests to me that we're going to have another financial shock at some point. I don't know if it's next month, next year, or when it is, but I think that the ground has been laid for another financial shock. You just look back on market history for the last 30 or 40 years, and nobody in retrospect would have predicted, a market crash in 87, another market crash effectively in the early 2000s with NASDAQ going down 80 or 90%. Then you had 2008, and then in the appearance of a pandemic that has killed millions of people. So, this is the world in which we live, and the amount of debt that we're carrying now as a result of these events over the last few decades makes further volatility more likely going forward, in my opinion.
We'll return to the podcast shortly. The AFMAN podcast is sponsored by TradeStation Global and the Society of Technical Analysts, the STA. TradeStation Global is a multi-asset trading platform with access to international markets where you can trade a range of instruments from one account and leverage professional-grade tools like Radar Screen, The Matrix, and Easy Language. And with TradeStation Global, there are no hidden price spreads, just transparent, low commissions. To find out more and to open an account, visit tradestation-international.com/alphamind or go to our website alpha-mind.net or see the link in the episode description. The Society of Technical Analysts, the STA, provide world-beating technical analysis education programs and offer outstanding membership services. AlphaMind podcast listeners can obtain a 10% discount on the cost of their excellent home study course and home study course with a diploma package. To find out more about this offer, go to our website alpha-mind.net or see the link in the episode description. Now back to the podcast. So how does that alter people's investment approaches going forward? Sort of the passive investment approaches as opposed to the more active investment styles.
I myself think it should encourage people to become more active in their investing, and by more active, I think there are several chapters to that book, and more active can just being more engaged and taking the time to be a better informed investor so that you can ask better questions about to your financial advisors, or if you have the inclination, the time and the inclination to take more responsibility with your own financial future and more actively set the strategy that you're going to adopt going forward. My concern with the passive investment approach is that it has become so large that it's become something of a Frankenstein's monster. I think it started out as a good idea, but over 50% of invested capital now in at least Western countries is devoted to passive strategies. And I think what's that's done also is created a generation or two of investors that lack the emotional experience and the skills of managing market volatility themselves. One of the appeals of passive investing, besides the lower fees, is that it's intellectually undemanding. And that aspect of it being intellectually undemanding, I think, has created a generation or so of investors that may not be best prepared for the kind of markets that I anticipate that we may experience, in which case then you may end up getting extra volatility as a result of the amount of money devoted to passive strategies if sentiment among the holders of these various passive funds starts to change substantially. There's no evidence that it has as yet, but that doesn't mean that a set of circumstances won't emerge that doesn't produce that. So all of these considerations suggest to me that we are going to see a good deal of volatility going ahead in the years ahead, and so to me, the rather than just sort of attempt to mirror index averages, I would prefer to look for individual opportunities where the risk reward is much more compelling. And for those that are the more serious investors, I would say that it would be important also to look beyond your domestic markets and look at international markets, maybe even look at other asset classes and so on. One of the nice things that's occurred over the last 20 or 30 years is the appearance of things like ETFs and so on, where investors can fairly easily get exposure to certain investment ideas much easier than they might have, back when I started in the business and so on. But, that's my concern about passive investing, is that what started out as a good idea, may end up creating a set of problems that will be difficult to reconcile.
Yeah, that'll be interesting to see how that happens. And I do wonder whether that played any part at all this year in some of the dynamics around the UK gilt situation, because a lot of passive funds were invested heavily into gilts as a low risk investment tool,
Yes.
which turned out to be quite high risk. I think they've lost more money than just about almost any other asset class this year.
Well, yeah,
Um,
well, actually, and I think that extends perhaps to a lesser extent through the bond markets of all the major nations. Which is ironic because for a long time, we had essentially a 40-year bull market in fixed income, and a lot of people who were looking for yield or looking for safety thought they found a refuge in the fixed income markets. Well, certainly 2022 is sort of been a rude awakening for many people, which once again sort of suggests that none of us can take things for granted or rest on our laurels, that even presumably the safest asset class can back up on you and create some serious losses.
and I think that really gets to the heart of macro. It is looking at some of the larger forces, and actually sort of sometimes being passive. A lot of the passive funds don't look at macro. They're maybe it's something that's a little bit of a kind of we're looking at sort of data, past performance, things like that all the time, to sort of, rather than planning ahead for active investment.
Yeah.
So I think that's a good example.
And also, the I think one of the reasons the last bull market one of the reasons that contributed to its rise, but also contributed to the very, very narrow leadership of the last bull market, was the passive investing, because a lot of passive funds do not hold the entire S&P 500, for example. They'll typically hold 75 or 100 of the largest names, which can effectively replicate their returns, particularly if they throw in some derivatives to kind of tweak things. And so what you end up having in the latter stages of the last bull market is you had a lot of passive money programs throwing money into the FANG stocks because they were the largest cap stocks, which ended up perpetuating the rise until, once again, markets will rise until they don't, and then they start going the other way. And we're seeing the FANG stocks are, well, some of them anyway, are leading on the downside. A chart of Meta and Tesla and so on, is a disturbing sight if you're
Yeah.
long these stocks. So.
Yeah, no, it's interesting times. Are you seeing any sort of people, customers of your newsletters? Has there been a change in the way they're sort of giving you feedback at the moment with regard to markets?
Well, some of them are, recently, and I do, it's a very nice community, I must say. I've been lucky that way, of the people that have subscribed, and I do hear from some of them from time to time. And there have been recently, one of the subscribers asked me to comment on concerns that he had been hearing about liquidity in the U.S. Treasury markets. And so I addressed that in the November issue of the Global Investment Letter, and so I have not detected a real dissonance in terms of their opinion about my concerns about volatility going forward yet. I do post on LinkedIn and some of my thoughts, and I'll comment on some charts on my LinkedIn account. And I'm much more apt then to get a bit of pushback from people that are bullish, that are anticipating a pivot by central banks in the near term, or are crypto enthusiasts and so on. Although I must say the crypto enthusiasts are becoming a smaller tribe over time, but not so much directly as my subscribers. 80% of the subscribers tend to be have a position in the financial industry. 20% would be, I guess, what would be called high net worth individuals. But I would say a good 80% are money managers, brokers, traders, and so on. And so they're a fairly sophisticated group, and I have their comments tend to be more directed at assessing the risks out there, as opposed to looking for reasons to buy. But I will say that the current bear market that we're in is going to end eventually, and I'm already in the process of looking for the potential leaders of the next bull market. I mean, some candidates have caught my eye that I put on my watch list, so to speak. Whether they turn out to be the leaders or not, I don't know. It's premature to say. But there are some sectors and some ideas that I think likely are going to lead the next bull market when it does occur, which it's not likely to happen in the immediate future, but who knows? But an observation I make in the Global Investment Letter and elsewhere is that every bull market has a new set of leaders, and so the leaders of the last bull market, while they still may be wonderful companies, are unlikely to produce the best risk reward opportunities in the next bull market. And we saw that in the late 1920s. That was led by radio stocks, and then you had the Nifty 50 market, in the late 60s, which was led by conglomerates and what passed for technology in those days, IBM and so on. Then, of course, you had the internet bubble at the turn of the century. Now we had the FANGs and so on. So every major market move tends to be characterized by a separate group of leaders. And I think that the next, worthwhile bull market that we're going to see is probably going to be the same. I mean, I've got some ideas, but it would be premature for me to talk about them because they're just ideas right now, and I don't have enough evidence to really justify whether I'm correct or not.
I think I would be failing my duty if I didn't at least try and ask you to to maybe give us a little clue of
well,
one
that I think is a core. Well, I can give you a couple of core investment themes that they might not be the best, the absolute best leaders of the next market, because I think that's probably going to be in the tech space. But a couple of themes that's a core long-term approach for me. One is defense, the defense sector. You've got a combination of technological innovation, which is introducing new products all the time, as well as the deteriorating geopolitical scene, which is clearly is causing weapon systems to be used at a fairly quick rate. Now, what I would say there, and I'm not currently long the sector because the price action hasn't said to me, time to get back in, because we're still in a bear market. But that would be an area I'd be watching, and where I would focus my my attention there would be on the companies that have the highest technological input into their products, such as the aerospace companies and missile systems and so on. And then another sector which I think is going to be, it will be hard to go wrong with longer term is healthcare, because the three of us are all baby boomers, and we're likely to need more healthcare in the years to come than we did 30 years ago. And thank goodness we're not alone. So the baby boomers are still around. And so I think that the aging demographics of the developed world, and once again, technological innovation and new drugs and so on, suggest to me that healthcare is probably one to look at. But once again, neither sector right now is one that I have a position in, because the price action has not vindicated my view. I exited those positions early in the year when the whole market just rolled over. But I think, though, as I say, those are core long-term themes for the global investment letter. And unless peace breaks out at some point in the world, the defense stocks is probably going to be a good place to be in the years to come. And unfortunately, I'm not that optimistic about the human animal that I think we're going to have peace on earth and goodwill towards men.
Just butting in for a second to add a little context. This episode was recorded in December, and it's clear that Jonathan was in a slightly seasonal mood with that last comment. We will return to the episode in a second. We just want to let you know of a one-day conference on the 18th of April in London called Technicals to Trading Systems. This event is being run by our sponsoring partner, the Society of Technical Analysis, the STA. This is open to finance professionals working in funds, banks, prop firms, asset management firms, commodity and energy trading firms, and research shops, as well as to serious-minded retail traders and anyone interested in systematic and quantitative trading and analysis. If you're in London, the UK or Europe, this is a great opportunity to hear some great speakers and to learn from them. It is also an excellent chance to meet and network with like-minded individuals. The STA have already announced a list of outstanding speakers, including our recent podcast guests, Robert Carver and Jeff Piccaccio, Professor Jessica James, Senior Quant Researcher at the German investment banking giant Commerzbank, technical analyst experts Trevor Neal and Eddie Topvik, and Victoria Scholar, Head of Investment at Interactive Investor. And there will be more speakers added to the event, and Mark and myself will also be appearing as speakers. And we would be delighted to say hello if you happen to be at the event. If you are unable to attend, you can also register to view the event virtually. To find out more and to register for this event, go to the STA website at technicalanalysts.com. Now back to the podcast.
I've got a quick question, actually. And this is stepping back to a really, really big macro picture, Jonathan. Do you notice any variance of mindset from countries' ability to respond from shocks? You know, that certain cultures are more rapidly responding to recover than others, and how you look at, where to potentially see opportunity.
Yeah. One of the things that affects countries' ability to respond to shocks and so on is their own internal political situation. And so, that can vary over time. What's concerning to me on a very broad geopolitical level is the rise of populist political parties in Europe and elsewhere. The history of that in the 1920s and 1930s was not particularly inspiring. So that's a potential source of concern for me in terms of the behavior of countries and their ability to respond to events and so on. Japan is an interesting country to me for a variety of reasons. I think that their equity markets offer great value, but at the same time, their central bank attitude towards maintaining rates at, to my mind, irresponsibly low levels and so on is a problem. And you look at what's occurred with the yen this year in terms of the rapid depreciation versus the dollar, and that we in the global investment letter we were on the bearish side of the yen for some time, and we participated in pretty well the whole move. And the same thing has happened, obviously, with the British pound and the euro. The dollar has come off more recently, but I don't know if the dollar can be expected to fall significantly more, because it remains the world's reserve currency, and the Fed is raising rates in such a way that the dollar still enjoys a positive interest rate differential over other major currencies. So currencies affect investment choices as well, because while I find some really interesting value in Japanese equities, the fact that I'm not a yen-based investor means that the depreciation of the yen this year would have really hurt my results if I had have been long Japanese equities, regardless of how well I selected them. So that's another reason why macro is important, is because you can look at international opportunities, but then you also have to put that within the context of how is the local currency going to perform versus your own. Investors have the option of hedging positions, the currency positions, but at the same time, hedging costs money as well, and so all of these things have to be factored in. Looking out, for the very long term, I still see great opportunities in emerging markets. This is for the longest term horizon that I would have, that I think that selected emerging markets are going to do very, very well over time, with the caveat being that I don't invest, looking out 20 years. I tend to just invest as long as evidence suggests that I'm right. So I never buy something with the idea that I'm just going to forget about it and hold it for 10 or 20 years. I buy I buy a position, and I'll hold a position for years if that's, what's indicated. But at the same time, I manage the trade. And I think that's a key concept too. You don't just buy something, then you have to manage a position after you establish it. And the managing the position becomes a function of evidence as it appears and so on. But I mean, notionally speaking, I think longer term, emerging markets are going to be interesting places to be, albeit probably volatile investment vehicles as well.
Yeah, interesting. The reason I asked the question was that we get so used to it in the UK of getting front page press telling us we're into a recession, it's going to be bad, it's going to be terrible. And in Spain, my wife is Spanish, it's always about the crisis. Sometimes countries talk themselves into holes, and I always see slightly less of that in on the American continent. There's a bit more buzz about bounce back.
I think Americans by nature are just an optimistic people.
Yeah.
Which obviously sometimes, I'm Canadian, so I have a bit of a different point of view, but my American cousins are basically almost always optimistic, which sometimes I causes me to scratch my head. At the same time, though, I think that optimism has also probably played a role in the success of the United States over the years.
Exactly.
So I think on balance, it's probably been a positive thing. But you're absolutely right. There is more optimism about a soft landing, which is, to me, in economic terms, is as close to a unicorn as you can get. I've never seen a soft economic recession in my life anyway. But and I don't think we're going to see one either. I don't think that's what the Fed wants, because if the Fed is intent on subduing inflation, it's going to have to cause the U.S. economy to slow considerably, which we saw back in the days of Volcker and so on. Although fortunately, the situation isn't as dire now. But I think you're absolutely right about that, Mark. That some nations are just a bit more optimistic, and it's a function of a lot of things. But in the United States, the dollar has been strong. Markets have been relatively. I mean, the U.S. markets for the last 7 or 8 years have been, I think, by far the strongest markets in the world, and a good part of that is the strength of the U.S. dollar, which has not only helped the domestic market, but it's attracted a lot of foreign capital flows into U.S. equities. And the perception of the United States as a safe haven for capital too certainly has played a role as global geopolitics have deteriorated somewhat over the last 4 or 5 years. So I do think that the U.S. may be the last holdout of optimism in the world. And eventually that sentiment is probably going to get tested. But I would also expect that, coming out the other side of the bear market, the U.S. will be, once again among the most optimistic as well. So, which on balance, I think serves them well over the long term.
Indeed. Anyway, I guess perhaps timely now to hand over to Steve. I think Stevie was just going to ask some things about where folk can find you and et cetera, and how they can get in touch with some of this free stuff you generate and some of the more formal stuff.
Yeah, you've asked it. I don't need to ask it now.
Oh, wow. All right. Well, thanks very much. Well, our website is theglobalinvestmentletter.com. There are sample issues of the Global Investment Letter available on the website. You just click on sample issues. And if you do that, you'll get access to the sample issues after you leave your name and email address. And then you also get put on a weekly email that I put out typically on a Tuesday, where I'll just talk about some aspect of investing or markets and so on. And certainly, the people that subscribe to the weekly email, they can unsubscribe at any time. So part of what I'm trying to do, as well as providing my analysis of markets, and each issue of the Global Investment Letter, I look at the major equity, bond, currency, and commodity markets. But as part of that, as well as I attempt to just impart some of the things I've learned as a money manager over the years. So not only am I sort of providing my analysis, I'm also just giving the subscribers some ideas on how they can manage their own investment positions and ask better questions of the people that are managing money for them, if that's the case, and so on. So that's about it.
Brilliant. And that's one of the things I really like about your investment letter. And I don't mean to be disparaging to people who produce analysis, but you've got skin in the game, and you can see that in the way you write. That there's stuff behind your forecasts.
Yeah, I mean, basically, it's kind of looking over my shoulder, and I talk about sort of what I'm doing, why I'm doing it, why I'm not doing something. I'll talk about, when I set up my sell prices, my stop losses, I'll say, okay, this is why I'm doing it at this level. With the idea being is that, people can sort of see and say, okay, well, he's doing that because that's technically an important level, and so on. And then, I'll talk about geopolitics, and I'll talk about investment philosophy and so on. So I just, each issue is an attempt on my part to just share some of the things that I've learned over the years. And I've been very fortunate that the feedback from subscribers has been very positive, which is to me heartwarming because, I love the investment business. Aside from the financial considerations, it's intellectually challenging. It's an attempt to try and figure out the world that we live in and so on. And I find that one of the things that drew me to the investment business was that. And I found that the people in the business tend to be, very bright, interested people. And so I just enjoy, keeping my hand in and keeping up with markets and sharing what I've learned.
Well, that's wonderful, and that's why we've had you on twice, because there is a surplus of wisdom there, and which you can't buy. It's all those years of experience.
Well, yes, they were hard-won years of experience.
Yeah.
If only I could go back 30 years, know what I know now. But that's not the way life works.
Mark, do you want to take us out?
Yeah, well, listen, Jonathan, great to have you on again. So relevant with what's going on and what's yet to come, I guess, because I think we've all been through those 30 or 40 years. And it's one thing after another, if you just look back historically. And keeping your eyes open on as broad a reach as possible is just so important. And I mean, just to re-emphasize that Jonathan's available on globalinvestmentletter.com with all of his details, just if you didn't pick that up. And I just want to leave you with a phrase, really, from what Jonathan said. Clarity equals confidence. Okay? Clarity equals confidence. So, Jonathan, many thanks. It's been an absolute pleasure.
Thank you, Mark. Thank you, Stephen. It's always a pleasure.
Thank you for listening today. We would like to thank our podcast sponsorship partners, TradeStation Global and the Society of Technical Analysts, the STA. You can find out more about our sponsors at our website, alpha-mind.net, or see the link in the episode description. TradeStation Global is a multi-asset trading platform with access to international markets where you can trade a range of instruments from one single account and leverage professional-grade trading tools. Visit tradestation-international.com/alpha-mind to know more. The Society of Technical Analysts, the STA, provide well-beaten technical analysis education programs. AlphaMind podcast listeners can obtain a 10% discount off the cost of their excellent home study course. We hope you enjoyed this episode. If you did, we'd appreciate it if you could leave a friendly review or provide a rating for the show on whichever podcast service you use. You can find out more about us at our website, alpha-mind.net. You can follow us on Twitter at AlphaMind101 and at AlphaMind102. And you can connect with me, Stephen Goldstein, and my co-host, Mark Randall, on LinkedIn. You can also follow us and can check back over some of our past episodes on the alphamindpodcast.com. We wish you the best of luck in the markets. Have a good week.